Welcome to our deep dive on maximizing the Backdoor Roth IRA strategy for high earners. First, we will define what a Backdoor Roth is and why it's so valuable. Next, we will unpack the Pro-Rata Rule, the critical pitfall that can make your conversion taxable. Then, we will walk step by step through a clean execution, compare your two strategic choices for old employer plans, and highlight blind spots that can derail your plan. Finally, we will test your knowledge with quick quizzes and end with a concise checklist and timeline so you can act confidently this year. Here is today's agenda. First, we'll cover what a Backdoor Roth IRA is and why it matters. Next, we'll break down the Pro-Rata Rule. Then, we'll detail how to execute a clean Backdoor Roth. After that, we'll compare your two choices for handling old employer plans. Additionally, we'll provide a practical timeline and checklist. We'll also discuss common blind spots and how to fix them. Finally, we'll test your knowledge with brief quizzes and wrap up with key takeaways. A Backdoor Roth IRA is a two-step maneuver for high earners whose income exceeds the limit for direct Roth IRA contributions. You first make a non-deductible contribution to a traditional IRA and then convert those dollars to a Roth IRA. The goal is to secure tax-free growth and tax-free withdrawals in retirement. Critically, the value here compounds over many years, making early and consistent use of the strategy especially powerful. Here's the mechanics. First, you contribute to a traditional IRA on a non-deductible basis. Next, you convert those dollars to a Roth IRA, ideally soon after the contribution to minimize any taxable earnings. However, the Pro-Rata Rule applies if you have any pre-tax money in any traditional IRA, SEP IRA, or Simple IRA. Specifically, the IRS snapshots your total traditional IRA balance on December 31st of the conversion year. If it's anything other than zero, a proportional share of your conversion becomes taxable. Therefore, the clean approach is to ensure your traditional IRA balance is zero on December 31st. When executed correctly, the converted funds land in your Roth IRA and can grow tax-free over time. This timeline emphasizes sequencing. First, make the non-deductible traditional IRA contribution early in the year. Next, convert to the Roth IRA soon after to limit any taxable gains. Meanwhile, keep your traditional IRA balance at zero throughout the year by not rolling pre-tax funds into it. Finally, on December 31st, verify your traditional IRA balance is zero. This order of operations reduces friction, prevents surprises, and keeps the conversion as tax efficient as possible. Let's operationalize this. First, ensure you have both a traditional IRA and a Roth IRA open at your chosen custodian. Next, make a non-deductible traditional IRA contribution, tracking the exact amount and date. Then, convert those funds to your Roth IRA soon after. Additionally, maintain accurate records. You will report your non-deductible basis on IRS Form 8606. Finally, confirm your traditional IRA balance is zero on December 31st of the conversion year to avoid the Pro-Rata Rule from creating a taxable portion of your conversion. You have two practical paths. First, you can keep old employer plans where they are. This can work if the plan has strong investment options and low fees that will not increase after you leave. Second, you can perform a clean sweep by rolling old pre-tax balances directly into your current employer's retirement plan, such as a 401k, if the plan allows incoming rollovers. Both routes aim to keep your personal traditional IRA balance at zero on December 31st, so your Backdoor Roth conversion remains tax efficient. Additionally, confirm that former employer plans won't introduce higher administrative fees once you're no longer on payroll. Let's compare. Keeping old accounts can be convenient and preserve access to excellent low-cost funds, and it avoids rollover paperwork. However, you must vigilantly monitor for administrative fee increases, and you will juggle multiple platforms. In contrast, the clean sweep consolidates assets in your current employer plan, which often makes maintaining a zero traditional IRA balance simpler and more reliable for ongoing Backdoor Roths. However, it requires your employer plan to accept roll-ins, involves processing time, and may limit you to the plan's fund menu. Ultimately, choose the option that balances costs, fund quality, and administrative simplicity while preserving a zero balance in personal IRAs. Use this checklist to decide between keeping old accounts or performing a clean sweep. Evaluate expense ratios, potential administrative fees, fund variety, and overall simplicity. Additionally, consider how each option affects your ability to maintain a zero balance in any traditional IRA. The clean sweep often provides structural simplicity for those committed to repeated annual backdoor Roth contributions, while keeping old accounts can be attractive when fund quality and costs are superior and fees remain stable. Watch for forced rollovers. If a former employer terminates its plan, you may be forced to move assets. In that case, act immediately and roll pre-tax dollars into your current employer plan to protect your backdoor Roth. Also, remember that pre-tax balances in SEP IRAs or simple IRAs count toward the Pro-Rata Rule, so avoid holding pre-tax dollars in any personal IRA. Moreover, delaying conversion after contribution can create taxable earnings. Convert promptly. Finally, keep meticulous records and file Form 8606 to properly document your non-deductible basis. Quiz time. Which statement about the Pro-Rata Rule is correct? Option A. It only checks your IRA balance on the day you convert. Option B. It checks all your traditional IRAs on December 31st of the conversion year. Option C. It ignores SEP and simple IRAs. Option D. It applies only if you contribute more than the annual limit. You may pause the video now to consider your answer. We will discuss the correct answer in the next section. The correct answer is, it checks all your traditional IRAs on December 31st of the conversion year. The IRS aggregates balances across traditional, SEP, and simple IRAs. If that combined balance is not zero at year-end, a portion of the conversion becomes taxable under the Pro-Rata Rule. Second quiz. Your former employer terminates its 401k and forces a rollover. What action best preserves a clean backdoor Roth strategy? Option A. Roll the money into a traditional IRA and deal with taxes later. Option B. Immediately roll the pre-tax balance into your current employer's plan, if allowed. Option C. Leave the funds in a taxable brokerage account. Option D. Convert the entire balance to a Roth IRA immediately, regardless of taxes. You may pause the video now to think about the answer. We will explain the correct option in the next section. The correct answer is to immediately roll the pre-tax balance into your current employer's plan, if allowed. This keeps pre-tax dollars out of any personal IRA, preserving a zero traditional IRA balance on December 31st and protecting the tax efficiency of your backdoor Roth strategy. Here are the key points. High earners can still reach Roth IRA benefits through the backdoor approach. The Pro-Rata Rule is the critical factor, so maintain a zero traditional IRA balance on December 31st. You can accomplish this by either keeping old employer plans where they are, if costs and options are favorable, or by rolling them into your current employer plan. Execute promptly, keep accurate records using Form 8606, and confirm your traditional IRA balance is zero at year-end. To summarize, the backdoor Roth is a two-step process. Make a non-deductible traditional IRA contribution, and then convert to a Roth IRA. The linchpin is keeping your traditional IRA balance at zero on December 31st of the conversion year. Choose whether to keep old employer plans or roll them into your current plan based on fees, fund quality, and administrative simplicity. Acting early each year helps you lock in tax-advantaged compounding and reduces the risk of unexpected administrative changes. Disclaimer: this content is for educational purposes only and does not constitute tax, legal, or investment advice. Always consult your tax advisor or financial planner to address your specific circumstances. Additionally, plan rules and tax laws can change, so verify current regulations and your employer plan's rollover policies before acting. Thank you for watching. As a final step, consider implementing your backdoor Roth plan this year to capture compounding sooner. If this video was helpful, please like it, share it with someone who needs this strategy, and subscribe for more actionable wealth-building content. In the comments, tell us your approach. Keep old accounts or clean sweep, and what hurdles you're facing. We look forward to your thoughts and questions.